In July of 1997, the Thai government announced that it would no longer defend its currency. The decision came after months of quiet intervention and mounting pressure in foreign exchange markets. Within days, the baht lost more than half its value. What followed was not confined to Thailand. Capital retreated across borders that had seemed, until then, firmly integrated into the global system. Banks failed, growth reversed, and institutions that had been treated as models of development required emergency support. At the time, the speed of the reversal surprised many observers. The structures that allowed it did not. For much of the early 1990s, East and Southeast Asia occupied a particular place in the global financial imagination. Countries such as Thailand, Indonesia, South Korea, and Malaysia posted high growth rates, expanding exports, rising living standards, and increasing integration with global capital markets. Their development strategies differed, but they shared certain features: relatively stable exchange rates, strong inflows of foreign capital, and a belief, held domestically and abroad, that their economic management was disciplined and forward-looking. The term Asian miracle was used frequently, often without close examination of its assumptions. Global conditions supported this confidence. Interest rates in the United States and Japan were relatively low, encouraging investors to seek higher returns elsewhere. Advances in financial liberalization made it easier for capital to move across borders, often faster than regulatory frameworks could adapt. For international banks and fund managers, emerging Asia appeared to offer yield without excessive risk. Many governments in the region, eager to sustain growth, welcomed these inflows. Exchange rate regimes were designed to signal stability, usually by pegging local currencies, directly or indirectly, to the US dollar. This arrangement appeared to work. Stable currencies reduced uncertainty for exporters and borrowers. Foreign capital funded infrastructure, real estate, and industrial expansion. Domestic banks grew rapidly, extending credit to firms that in earlier decades would have relied on retained earnings or state-directed finance. The system rewarded continuation. As long as capital flowed in, reserves accumulated, asset prices rose, and the appearance of stability reinforced itself. Beneath this surface, vulnerabilities accumulated unevenly. In several countries, financial liberalization outpaced supervisory capacity. Banks borrowed short-term in foreign currencies and lent long-term in domestic ones, often to sectors tied to property or construction. Corporate balance sheets became increasingly exposed to exchange rate movements that were assumed to be unlikely. Governments, confident in their reserve positions and growth prospects, saw little reason to disrupt a model that delivered visible results. The logic was not irrational. For years, currency pegs had held. Export earnings grew. Foreign investors, observing consistent policy signals and strong headline numbers, treated deviations as temporary. Credit ratings remained high. When concerns were raised, they tended to focus on individual countries or sectors, not on the regional structure as a whole. Risk was perceived as contained within national boundaries. The first significant rupture occurred in Thailand. By 1996, signs of strain were visible. Export growth slowed, property prices softened, and the current account deficit widened. Speculators began to question whether the central bank could continue to defend the baht without exhausting its reserves. The Thai authorities responded as they had before, intervening in markets, tightening some controls, and reiterating their commitment to the peg. These actions delayed adjustment, but did not remove the underlying imbalance. When the peg was finally abandoned, the move reflected constraint rather than strategy. Reserves had been depleted through forward commitments that obscured the true extent of exposure. Once the baht was allowed to float, its decline forced a rapid reassessment of balance sheets across the economy. Firms that had borrowed in dollars faced liabilities that suddenly exceeded their capacity to repay. Banks, already exposed to the property sector, absorbed losses that eroded confidence further. The revaluation of risk did not stop at Thailand's borders. Investors who had treated the region as a diversified portfolio began to reassess that assumption. Similar exchange rate regimes, similar funding structures, and similar patterns of short-term foreign borrowing suggested that vulnerabilities might be shared. Capital outflows spread to Malaysia, Indonesia, and the Philippines. In each case, currencies came under pressure, reserves declined, and authorities faced the same choice between defending pegs and preserving liquidity. Indonesia's experience illustrated how quickly financial stress could intersect with political fragility. The rupiah's depreciation exposed corporate debt on a scale that overwhelmed existing institutions. As confidence deteriorated, capital flight accelerated, and inflation followed. Attempts to stabilize the situation through interest rate increases and fiscal restraint struggled against the loss of trust. The crisis, initially framed as financial, became social and political, contributing to the end of a long-standing regime. South Korea's position differed in important ways. Its industrial base was larger, its export sector more diversified, and its institutions more developed. Yet it, too, relied heavily on short-term foreign borrowing to fund long-term investment by large conglomerates. When international banks began to reduce exposure, refinancing became difficult. By late 1997, South Korea faced a liquidity shortage that threatened its ability to meet external obligations. An emergency program coordinated with the International Monetary Fund provided temporary stability, but only after significant disruption. The responses to the crisis varied, but they shared certain features. Exchange rates were allowed to adjust sharply. Interest rates were raised to defend currencies and contain inflation, deepening recessions in the short term. Banking systems underwent restructuring, with insolvent institutions closed or merged. In several countries, IMF-supported programs imposed conditions aimed at restoring confidence, including fiscal adjustment and structural reforms. These measures were controversial, both at the time and in subsequent interpretations. Markets reacted not only to policies, but to perceptions of coherence and credibility. In some cases, inconsistent signals amplified uncertainty. Capital controls, where imposed, slowed outflows but carried reputational costs. Coordination among international lenders was uneven, revealing the limits of ad hoc crisis management in an integrated system. The speed with which capital had entered the region contrasted with the difficulty of stabilizing it once sentiment reversed. As the immediate crisis subsided, narratives began to form. One emphasized domestic mismanagement, weak regulation, crony capitalism, and excessive leverage. Another focused on external forces, volatile capital flows, herd behavior, and the procyclical nature of global finance. Both contained elements of truth, but each simplified a more complex interaction. The structures that failed were neither purely local nor entirely external. They reflected an alignment of incentives that rewarded growth and integration while discounting systemic risk. In retrospect, the stability of the early 1990s appears conditional. Fixed or tightly managed exchange rates encouraged borrowing in foreign currencies by signaling low exchange rate risk. Liberalized capital accounts facilitated rapid inflows without corresponding mechanisms to manage sudden reversals. Domestic financial systems expanded balance sheets faster than supervisory frameworks could evolve. These elements did not guarantee crisis, but they reduced the margin for adjustment when conditions changed. The crisis also reshaped institutional thinking. Reserve accumulation became a priority across emerging markets, reflecting a desire for self-insurance against future shocks. Exchange rate regimes became more flexible, allowing for gradual adjustment rather than abrupt breaks. Regional financial cooperation increased, though unevenly. International financial institutions reassessed aspects of their policy frameworks, incorporating lessons about capital flow volatility and financial sector oversight. Yet some interpretations obscured as much as they clarified. The focus on moral hazard or individual policy errors sometimes diverted attention from the broader architecture of global finance. Capital mobility remained high, and the incentives that drove short-term lending and borrowing persisted. Regulatory reforms improved transparency and capitalization in many countries, but they did not eliminate the cyclical nature of risk perception. By the early 2000s, much of Asia had recovered. Growth resumed, currencies stabilized, and integration with global markets deepened further. The memory of the crisis influenced behavior, but it did not reverse the underlying trajectory. The system adjusted, incorporating buffers and safeguards that reflected past experience. Whether these adjustments addressed the core vulnerabilities or merely shifted their form remained an open question. The Asian financial crisis of 1997 is often described as a turning point, but its significance lies less in its dramatic moments than in the structures it revealed. Stability, it showed, could coexist with fragility when assumptions went untested. Integration could amplify both growth and reversal. The events unfolded without a single point of failure, emerging instead from aligned decisions that appeared reasonable in isolation. When the currency stabilized and the emergency programs ended, what remained was not a definitive lesson but a set of unresolved tensions. The balance between openness and resilience, between market discipline and institutional capacity, continued to shape policy debates. The crisis receded into history, referenced more often than examined. Its contours became familiar, even as its implications resisted closure. The system moved on, carrying with it the memory of a period when confidence shifted faster than institutions could respond. What endured was not consensus, but awareness, partial, uneven, and dependent on context, of how quickly stability could give way, and how quietly the conditions for that shift could accumulate.